So I hope this post doesn't come across as unpatriotic. I really love being an American and feel incredibly blessed to live in the greatest country on earth. But admittedly, I don't enjoy paying taxes. I think if most of us are honest about our duties, Americans will admit that taxes are necessary to provide commonly shared infrastructure and services that make life better for all of us. But I think we'd also admit that we're not always thrilled about the way the government uses our tax dollars, and we would prefer to limit our tax liability as much as legally possible. So in that spirit, I thought it might be interesting to share 11 of my favorite tax saving strategies. To be clear, the level of benefit these produce for you will depend on your personal tax situation and the state that you live in. Some of these may not help you at all, and there may be some missing that could be particularly beneficial to you. Also, there's a lot of information in this video. It's one of the longer ones I've ever done, but it really could be worth loads of money to you in tax savings. Hang in there because I think it will be worth your while. And finally, I'm not an accountant or tax attorney. You should consult with a tax professional before engaging in any of these strategies. And with all that out of the way, here are my 11 favorite tax strategies in no particular order. The first one is tax advantage retirement accounts. Now this is one that I'll refer to often in this video. Tax advantage retirement accounts are accounts that provide some sort of tax incentive in order to encourage people to save and invest for retirement. Now you're probably familiar with most of these 401ks, IRAs, 403bs, 457s, there are a lot of others. Now normally these plans provide a tax deduction either on contributions or they allow you to make tax-free withdrawals after you reach a certain age, which is normally 59 and a half. I'll spare you a lengthy explanation and just hope you trust me when I say that there is indeed a considerable long-term benefit available to those who use these plans. If you want more detail, we have a video linked above about ranking retirement plans in order. It kind of gives an overview of each account, some of the pluses and minuses, pros and cons of each one of those, and what they accomplish for you from a tax basis. But for the most part, these plans either provide you with tax-deferred earnings or the earnings grow completely tax-free after you make after-tax contributions. Now, the extent of the benefit will depend on your state and federal taxes when you make contributions and when you make withdrawals, but on average, these accounts should save you around 10 to 20% or more of the value of your total accounts balance. Each of these accounts come with varying levels of contribution limits. Usually it's based on your adjusted gross income. Here are those limits for 2024. These accounts are widely available to almost all Americans with earned income. And as we kind of go through the video, you'll see me make reference to these several times. The second tax saving strategy is health savings accounts. HSAs were primarily created to incentivize people to migrate toward high deductible health plans, which basically shift the burden or cost for small medical events from the insurance company to the insured. Now, a high deductible health plan is exactly as the name describes. It's a health insurance plan with a higher deductible. And this means the insured party pays their medical expenses out of pocket until they reach these higher deductibles. The idea is if people have skin in the game, they're more likely to make thoughtful decisions about their health and medical care. So to assist with the potential costs of high deductible health plans, HSAs were created to allow account owners to put away thousands of pre-tax dollars each year, which could potentially be invested in a wide range of securities. And if the withdrawals for an HSA are used for qualified medical expense, the contributions, earnings, and withdrawals or payments from the account are completely tax-free. That makes HSAs potentially more valuable than the retirement accounts we covered previously. Additionally, if you contribute to an HSA through payroll deduction, your contributions avoid Social Security and Medicare tax as well, which is another 7.65% of taxes that you'd otherwise have to pay. Now, there are limits for annual contributions to HSAs, which are in the table on your screen. The good news is there's no limitation on how high your HSA can grow. Now, since the typical American will spend well over $300,000 on medical expenses between age 65 and the time that they pass away, HSAs can be a very effective saving tool. There are a few other HSA features and rules to keep in mind. The first one is any withdrawals made from an HSA for any reason other than a qualified medical expense before age 65 are subject to income taxes and a 20% early withdrawal penalty. However, when you do turn 65, you are allowed to withdraw funds from your HSA for any reason. You won't owe any penalties for these withdrawals, but you will owe income tax, effectively making the HSA similar to other tax-deferred retirement accounts. Finally, HSAs are one of the least state-friendly retirement accounts because inherited HSAs must be completely liquidated in the year they are inherited, making them fully taxable to the account beneficiaries. Now, if the balance isn't very large, this isn't a big deal, but if you leave a large sum of money to an heir that already has a relatively high marginal tax rate, much of the balance will be claimed by Uncle Sam. The one very notable exception to this is spouses. If you pass away and leave an HSA to your spouse, they get to use the account as if it was their own until they pass away. Tax saving strategy number 3 is owning a business. Now, we could follow this third benefit down some very deep and complicated rabbit holes, but for the sake of brevity, I'll try to hit some of the more popular tax benefits of owning your own business at a high level. Now, I should also mention that even though there are many tax benefits available to business owners, there are also many tax burdens placed on them as well. If you have a small business or plan to open one, these may be of use to you, but I would not recommend inventing a business primarily for the sake of taking advantage of a tax deduction. And speaking of deductions, the first benefit is a deduction. Now, expenses incurred for the sake of starting, operating, and even closing a business are tax deductible. This could include anything from meals and entertainment to cars, travel, professional services like accounting, financial, legal help. As a small example, I actually started martinmoney.com and our YouTube channel as a hobby, but it now operates as a small business. And the expenses I previously incurred for software licensing, domain fees, electronic equipment, etc. are now tax deductible. And since I was in the 24% marginal tax bracket last year, the expenses that were eligible for a deduction through my business effectively came at a 24% discount. Now granted, it's not much for my small business, but $240 saved for every $1,000 spent is a pretty strong savings rate. The next potential business benefit is solo 401ks. If you own and operate a small business by yourself, in other words, you don't have any employees, then you can open a solo 401k on your own. And solo 401ks work similarly to regular 401ks with a few notable exceptions. In 2024, you can contribute up to $23,000 to a solo 401k. That actually goes up to $30,500 if you're 50 or older. That's as the employee. And as an employer, you can contribute all the way up to $69,000 or $76,500 if you're 50 or older. Now, a fun feature of solo 401ks is that you can make these contributions even if you participate in an employer-sponsored 401k plan at another job. So if your small business is a side hustle, it could effectively double the amount of space available for 401k contributions each year. To be clear, you only get cumulative annual employee contributions of $23,000 for all the 401k plans you have, but you can make the full $69,000 or $76,500 if you're 50 or older, that larger contribution as the employer into your solo 401k. And if your spouse works in the business, they're eligible to participate as well. They're the only other person that you can have in the business as an employee though. So if your small business does well enough, that gives you a ton of room for stashing away tax advantage retirement savings. Now, unfortunately, if you have a 403b with an employer and open a solo 401k through your small business, your cumulative contributions cannot exceed the annual limit of $69,000. That was $76,500 if you're 50 or older, which basically means even though you have two plans, you only get the contribution limits for one. Now, this is a really lame rule, I'll admit, but it is a thing. Finally, note that if your solo 401k balance reaches $250,000, you'll need to submit Form 5500EZ with your annual tax return. This is a reporting requirement only, but it isn't one you want to forget. There are a few other tax benefits to owning a business. Deductions for interest, marketing, insurance, mileage, moving, rent, internet, etc. Those are all important to remember. Depreciation for certain assets. This is especially beneficial if you own rental property. Finally, the square footage in your home that's dedicated to a small business can be deducted as well, though it's a bit of a pain to jump through all those hoops. Tax saving strategy number 4 is income from investments. Now, Warren Buffett was once famously quoted for commenting that his secretary pays more in taxes than he does each year. And to be fair, Warren phrased this rather poorly to make a point. In the context of the conversation, Mr. Buffett meant that his secretary pays higher taxes as a percentage of income than he does. And while this distinction may be less shocking, it might still generate some confusion. So to clarify, he's referring to the differences between long-term capital gains tax rates and the tax rates the IRS levies on income in the United States. Now, we've got the 2024 tax brackets for income and for capital gains and qualified dividends on your screen now. The bottom line is long-term capital gains and qualified dividends are taxed at lower rates than income. This means you get to keep more of the money you make from investments than you do from your labor. I'm not really here to argue the merits of that approach, but I do want you to be aware that the money you make from your investments can produce a tax benefit. And this is how extremely wealthy people manage to pay as little tax as they do. That and the fact that they pay a bunch of very smart people to shield their money from taxes. So as an example, let's assume you're 63 years old, you're retired, and you want to liquidate $50,000 of your investments to buy a boat. Let's assume your options are to make the withdrawal from your IRA or to sell assets you've held for years in a taxable brokerage account to access the funds. Now, we'll further assume that you already pull your living income from the IRA, which puts you in a 22% tax bracket, and half the value of the assets you'd sell from the taxable brokerage account are capital gains. If you pulled the $50,000 from your IRA, you'll owe another $11,000 in income tax because 22% of $50,000 is $11,000. But if you sell the assets in the brokerage, you'll only owe $3,750 in capital gains taxes because only half of the assets sold were gains, and they were taxed at 15% instead of 22%. So $25,000 times 15% is $3,750. Now, to be completely fair, the cost basis in your taxable brokerage account was almost certainly taxed as income before you transferred those funds into the account, but you're still better off accessing the funds as capital gains instead of taxable income. Tax strategy number 5 is tax gain or tax loss harvesting. Now, continuing along the thread of tax savings through investing, tax gain and loss harvesting are effective ways to save money. So tax loss harvesting is a strategy that can be used during a period of significant depreciation in the value of an asset, usually stocks, or mutual funds, ETFs, things like that. And since the losses in the value of invested assets are deductible, intentionally realizing a capital loss provides you with an instant tax deduction. The problem with selling to trigger a loss is that 1, it's a form of market timing, and 2, it could potentially sacrifice asset allocation for the sake of tax savings, because effectively when you sell an asset, you move it out of bonds or stocks or whatever it's in into cash, which means your asset allocation instantly changes. Now, to avoid these two issues, you should immediately rebuy a similar asset that isn't substantially identical to the one you've just sold at a loss. You can't rebuy a substantially identical asset for at least 30 days plus 1 after the sale of an asset you sold at a loss, because this negates the deductibility as a result of the IRS's wash sale rule. I'm not going to attempt to define substantially identical here, as I'm not a tax professional for one, and as far as I know, the IRS has never bothered to define it either. What I will say is that when I do have a tax loss to harvest in the past, I elect to rebuy an asset for which I can easily explain the difference from the one I sold. So for example, if I had an S&P 500 ETF at a loss and I sold it and then rebought a large cap index fund, I could explain the difference between an S&P 500 index and a large cap index. Even though they probably behave in a similar way, I can explain what the differences are, so they're not identical if I can do that. Now, after 31 days have passed, I may sell that large cap index fund and move back to the S&P 500 ETF if I so choose. And shamefully, I've also negated a capital loss by forgetting that I had just sold the asset a few weeks earlier and I triggered the wash sale rule. The good news is my brokerage caught the wash sale and my 1099 was drafted to account for this at the end of the year. And there isn't a penalty for a wash sale unless you try to take the deduction anyway. So if you do commit a wash sale, don't worry about it. You just won't get a tax deduction for doing that. Now, the good thing about capital losses is they can be used to offset up to $3,000 of income each tax year, and any excess losses can be carried over indefinitely. Now, if you do have carryover losses, be sure to record them on the IRS's capital loss carryover worksheet when you do your taxes. I'll have a link to that down in the comments below. Also, capital losses can be used to offset an unlimited amount of capital gains, which will make more sense as we discuss tax gain harvesting. So just like we use tax loss harvesting to trigger a tax deduction at an advantageous time, we can use tax gain harvesting to realize gains when they'll be taxed at low rates, or to offset those gains using tax losses from earlier in the year or from previous years. So as an example, let's assume that you sold a stock at a $10,000 loss at the beginning of the year. And toward the end of the year, the stock you bought to replace the one you sold at a loss has now realized a $5,000 gain. In order to harvest this gain completely tax-free, you decide to sell it and use your losses from earlier in the year to avoid any taxes. Now, one feature of harvesting gains is there's no wash sale rule, so you can immediately repurchase the security you sold for a free step up in basis, or you can buy a different one. So great, you've spared $5,000 in gains from taxes, but you still have $5,000 from the loss left to claim. Well, if you don't have any other assets that you can use for gain harvesting, you can use $3,000 of the remaining losses to offset taxable income that year. The remaining $2,000 in losses can be carried forward to future tax years indefinitely. There are some long-term tax strategies for loss harvesting. I prefer to use them as soon as possible. That way I don't have to keep up with them forever. And there's also a time value component that deteriorates a little bit of the value over time. Also, it may seem obvious, but you can only tax harvest in taxable accounts. These strategies are kind of pointless in a tax-deferred Roth, health savings, 401k, IRA, anywhere like that where you're already getting a tax benefit. There's no tax on the transaction when you buy or sell the gain or loss. That's realized when you actually pull money from the account later on, so this only works in a taxable space. Finally, you can harvest both short and long-term gains and losses, but losses will first be used to offset gains of the same type. Remaining losses can then be used to offset gains of different types. By the way, if the information in this video is helpful to you at all, please click like and subscribe below. That'll help our channel to grow. It actually allows me to continue making videos like this to help people learn about personal finance. Tax strategy number 6 is donor advised funds. Now, there are many ways to receive tax benefits from charitable gifts. The first one we'll discuss is donor advised funds. If your tax situation is such that you don't itemize, meaning the standard deduction is more valuable than the value of the itemized deductions, including donations, You can use donor-advised funds to combine several years' worth of donations into 1 year. That makes it beneficial to itemize for one single year while still making donations to charity at any time. So let's say you're a single tax filer and your annual standard deduction is $13,850. And you also enjoy making annual gifts of $8,000 to charity, but when combined with other deductions, it still isn't enough to make sense for you to itemize your taxes. If you use a donor-advised fund, you can contribute the equivalent of 3 years of donations into a single tax year, providing you with a $24,000 deduction. Since you can direct the timing of donations from your donor-advised fund, this allows you to take advantage of your gifts for one big deduction in a single tax year while still being able to take advantage of the standard deduction in other years. And the benefits aren't limited to taxpayers who don't typically itemize. You could use a donor-advised fund to offset a major influx in income in a given year from like the sale of a business or large asset, or to take advantage of standard deductions that are currently at an all-time high. Donor-advised funds can be set up through all the major brokerages and are typically easy to use. Simply fund the account and you get a deduction. You do need to keep in mind, however, that contributions to a donor-advised fund are irrevocable. You cannot get them back out of the donor-advised fund if you change your mind. Also, deductions for donations are limited to 60% of your adjusted gross income for cash gifts. That's 50% if placed in a donor-advised fund, and 30% of your adjusted gross income for appreciated non-cash assets like stocks, bonds, mutual funds, things like that. Tax strategy number 7 is one of my favorites, donating appreciated stock. All right, another popular way to use taxable brokerage accounts is to donate appreciated stock or funds directly from the account to your charity of choice. I do this myself, and last year in 2023 it actually saved me around $600. Here's how it works. As we've already covered, the sale of an appreciated asset triggers a tax on any capital gains that are realized from that sale. But if you donate the asset instead, the value of that donation, both the basis and the gains, is completely tax deductible. And you might be thinking, gee, that's great, Kurt, but it's also deductible if I just write a check to the charity. That's a very valid point, but if you repurchase the stock you just donated in the same value you donated, you now have the same amount of stock with zero unrealized gains, and you still get the same deduction. In other words, donating stocks provides a path to a free step up in the tax basis of the stocks, meaning you avoid all the capital gains without any material change to your portfolio's value or your asset allocation. So for example, let's say you donate $1,000 of ABC stock to charity and $200 of that is capital gains. If you donate the stock and immediately rebuy it, you get the same $1,000 of ABC stock, you get a $1,000 tax deduction, and your tax basis for the stock is now $1,000 instead of $800. The net result is the capital gains tax is saved on $200. This is also an effective way to rebalance your asset allocation if you want to donate an asset that you're over allocated in and want to rebuy another one for which you have an under allocation. Tax saving strategy number 8 is qualified charitable distributions. So if you're at the point in life where the IRS is forcing you to remove unneeded income from your retirement accounts through required minimum distributions or RMDs, you can donate assets from your retirement accounts to satisfy those RMDs. These are called qualified charitable distributions or QCDs. They are quite handy if you don't need your RMDs for living expenses and you are charitably inclined. Now to be clear, there's no tax deduction for qualified charitable distributions, but they do allow you to avoid paying income tax on income you don't really need while benefiting a charity. You can also use QCDs to reduce your retirement account balances that are subject to RMDs, effectively reducing future tax liability. In 2024, QCDs are limited to $105,000 annually per taxpayer, so if you're married, your spouse can also make a QCD of $105,000, meaning I guess you get up to $210,000 in QCDs per household per year. You also have to be at least 70 and a half years old to begin making qualified charitable distributions, even though RMD age now is age 73 or 75, depending on when you were born. Number 9 is Roth Conversions. Continuing on the theme of RMDs, you can use Roth Conversions to sort of limit their impact in retirement. I've already mentioned that RMDs begin at age 73 or 75, depending on when you were born. If you were born before 1960, they'll start at age 73. If you were born after 1959 and 1960 or later, they'll begin at age 75. Now, meanwhile, the average American retires around age 65, and odds are if you don't need to take money out of your tax-deferred accounts, you have enough to retire even earlier than that. So if this describes you and you expect RMDs to be an inconvenience, you may have several years to convert those dollars to a Roth IRA, providing a path to potentially avoiding RMDs altogether. Typically, people use the years between their retirement from full-time work and RMD age to slowly convert tax-deferred assets to Roth at a tax-efficient pace. Since you don't have full-time or maybe any working income, you should have a much higher degree of control over how much you remove each year from retirement accounts, meaning you effectively control your tax rate. So for example, let's assume you're 62, retired, and you primarily live on the assets in your savings or taxable brokerage account. As a result, your marginal federal tax rate is only 12%. Well, since conversions from a tax-deferred account to a Roth IRA are taxable, you can convert a sum that takes you to the top of the 12% bracket and pay 12% federal tax instead of a higher tax rate when you reach RMD age. Or maybe you want to convert all the way to the 22 or 24% bracket. Many people do. The point is Roth conversions provide an opportunity to use your early retirement years to optimize the tax efficiency of the assets in your portfolio by paying any income taxes in lower income years. If you expect that you could benefit from Roth conversions one day, I highly recommend that you keep enough cash or cash equivalents available in the 2 to 5 years leading up to Roth conversions so you can pay the tax bill on those conversions. Otherwise, you'll have to cannibalize your new Roth dollars to pay the tax on the conversions, which would be a real shame. Tax saving strategy number 10 is to open a 529. If you have kids and plan to provide financial support for their education, a 529 education savings plan is a great way to do that. 529s work similarly to a Roth IRA in that contributions are made on an after-tax basis and they're allowed to grow tax-free. Withdrawals are also tax-free if they're used for a qualified educational expense. In addition to that, in 33 states plus Washington, D.C., contributions to a 529 may be deductible on your state income tax return. The limitations do vary greatly, so check with your state to understand the tax implications fully. The major downfall of 529 plans is the relative lack of flexibility for using the money. Education is the only tax-free option for withdrawals, and you'll even owe a penalty if your withdrawal isn't due to a scholarship being provided to the beneficiary or a few other select exceptions. Even if you can manage to remove funds without a penalty, you'll owe income tax on the gains if you don't spend it on education. In 2024, Secure Act 2.0 ushered in an option for 529 funds that remain after a beneficiary has completed his or her education. You can now use up to $35,000 of 529 assets to fund Roth IRA contributions for the account beneficiary up to their annual contribution limit, assuming they have sufficient working income. This extra flexibility does help, but you'll still be best served by not over-contributing to a 529. Tax saving strategy number 11 is to use your estate. So finally, there are several opportunities to save taxes in your estate planning. Actually, there are more than I'll have time to cover in this video, and it's already gotten quite long, so I'll just hit a couple of common things here. First, you can save your family quite a bit of headache and expense by establishing a trust as a mechanism for distributing assets in your estate instead of forcing them to probate a will. Technically, a relatively small portion of the expense is related to taxes, but there's still a lot of other things that you'll save the money on, so I included it anyway. Another important strategy is to keep in mind the fact that appreciated assets like stocks and real estate receive a free step up in their tax basis when the ownership is transferred as an inheritance. Unfortunately, many people jump the gun and either transfer all or partial ownership of these assets prior to their death, forfeiting a significant tax benefit in the process. You should especially avoid the temptation to serve as the co-owner of real estate or other accounts prior to the death of a parent or a loved one. There are other ways to manage custody and to help elderly loved ones without sacrificing the improved tax basis. The final thing I'll suggest is to be thoughtful about how your beneficiaries are designated on your tax-advantaged accounts like IRAs and HSAs. We've already pointed out that HSAs don't make the best inheritance because they're fully taxable to beneficiaries in the year they're received. You should also keep in mind that the difference in marginal tax rates between you and your heirs may call for strategic tax planning as well. So for beneficiaries in higher tax brackets, the net exposure to taxes will be reduced if you leave Roth assets to them. On the other hand, if they're in lower brackets, the net benefit will be higher if they inherit tax-deferred accounts. In either case, beneficiaries of IRAs will have 10 years to liquidate the account, so there's quite a bit of runway for making distributions, allowing room for further tax planning. So there you go, 11 tax strategies. Hopefully you found at least a few of these tax saving opportunities helpful, and some of this results in real tax savings for you and your family. And be sure to check out our YouTube channel for more information about tax efficiency and other investing topics. We actually have a playlist completely dedicated to tax efficiency. Also, if you're watching this and you have an idea about a topic you'd like me to discuss, please put that in the comments below and I'll try to cover it in a future video. As always, we're grateful for your interest in our videos. God bless and take care.